Hey traders, welcome to the Forex Beginners course. This is Corey Mitchell. Video 1, we are looking at what is the Forex market. We're just going to look at some basics of what it actually entails, brought to you by investo.com. So Forex is the simultaneous buying of one currency and the selling of another. This is why currencies are always listed in pairs. So you have the Euro USD, for example, the USD JPY. And it's always a simultaneous buying and selling, because you can think of it if you're going to the bank. Say you're in the US, so you have US dollars, and you're going on a trip to Europe, you're going to need to exchange your US dollars for euros. So you're selling your US dollars to buy euros. So there's always going to be two transactions that occur simultaneously. You're getting rid of one to get the other, which means there's always those two transactions going on, and you can never be totally out of a currency. By that I simply mean you're going to have to exchange at some point one currency for another. You either have euros or you have US dollars, but you're going to have either one of them. And especially when we're trading in Forex, we're looking to profit off of fluctuations in currency rates, so we're always going to have one of those positions. So we're either going to want to have euros, and then we're going to have to get rid of them to get US dollars, or we're going to have US dollars and we're going to want to swap them out for euros. So each currency has an abbreviation. The euro is EUR, the USD is US dollar, JPY Japanese yen, AUD is Australian dollar, NZD New Zealand dollar, GBP British pound, CAD is the Canadian dollar, and CHF is the Swiss franc. These are the main currencies that you're going to be using, and we can create pairs by mix matching all these that we have listed here. So you can have the CAD Swiss, the NZ JPY, the Euro JPY, AUD NASD, all sorts of combinations, and these are going to be the main currencies that most traders are going to focus on. If you buy the Euro USD, you are buying the euro and selling the US dollar. You're therefore expecting the euro to rise relative to the US dollar. If you sell the Euro USD, you're selling the euro and buying the USD. You're therefore expecting the euro to fall relative to the US dollar. So if we look at this case, this would be the example of you are taking your US dollars to a bank to exchange them for euros. If while you are holding those euros it goes up in value, you're going to make a little bit of money when you go back to the bank later and exchange those euros for US dollars. And that's basically what we're doing in the Forex market. Is all we're doing is converting one currency to another if we believe that it's going to appreciate relative to that currency. So in this case, if we buy the euro, we want it to go up so that when we exchange it back, we can make a profit. So the price of a currency is affected by how global factors such as the balance of payments, which is the difference between imports and exports within a country, demand for currency via international trade, so how much money is needed to buy international goods, the inflation and interest rate outlook of for each country, as well as traders simply buying and selling based on these and other factors. So these are all going to affect how the price of a currency pair is determined. So for inflation and interest rates, the higher an interest rate is, generally the more attractive it is to international investors, which is then going to create a demand for this currency. So if you have a low interest rate in the US and you have a high interest rate in Australia, Australia becomes more attractive to investors in the US because they can get a higher interest rate there. So they may sell some of their US dollars to buy Australian dollars, place some of those in an Australian bank, or simply in the Forex market we just buy the Australian dollar, and we can benefit from that higher interest rate. So these all affect how the attractive a currency is relative to other currencies, which therefore affects its price. Also, simply traders. I'm sitting at home trading, you're sitting at home trading, or will eventually be, and lots of other traders and banks are also buying and selling currencies constantly. It's a very speculative market. So all our actions help determine what the price is going to be. So if I think the price is going to go up, I'm going to put out orders to buy certain currencies, and that's going to help push the price up along with all the other traders who are doing the same thing. So I base my trades off technical analysis, and a lot of other traders do as well, so that's going to have a small impact on the price of the currency as well. So most currencies are priced to 5 pips. The Euro USD, for example, will be priced at a number looking like this. So it'll fluctuate all the time, but currently it could be trading at 1.36451, so these are 5 decimal places. The 4th decimal place is what we call 1 pip movement. So if this goes from 4.5 to 4.6 or down to 4.4, that would be a 1 pip movement. This 5th decimal place is what we call a fractional pip, and that is simply 1/10 of a pip. So up until a few years ago, we didn't have fractional pip pricing. All we had was 4 decimal places, but now with brokers becoming more competitive, more volume in the Forex markets, online brokers, advances in technologies, all these things, we now have that 5th decimal place, which just makes pricing that much more accurate. So what does that actually mean? For the cost, it means you are paying 1.36451 US dollars for each 1 euro. So you can always think of the front currency in a pair as 1. So in this case it's euro, and the price of the currency is how much it costs of the second currency to buy the first. So let's look at the JPY. For example, the USD JPY might be priced at 102.564. So that means it costs 102.564 JPY or yen to buy 1 US dollar. So 102 of these plus the decimal point to buy 1 US dollar. JPY pairs are priced to 3 pips. So in this case, we have the second currency, or the second decimal is what we call a pip, and the third is the fractional pip. So if this number goes from 102.56 to 55 or to 57, that would be a 1 pip movement. You will see this third number also move, and that's simply the fractional pip. So that's 1/10 of a pip. So this whole number will fluctuate all the time, and this will go up and down, and then when you have a full pip movement, this one will move. So we trade Forex in 3 position sizes. Micro lots, which are equivalent to about $1,000, mini lots, which are equivalent to $10,000, and standard lots, which are $100,000. So you can take varying position sizes based on these lot sizes. For example, you can take 5 micro lots, which would be $5,000. You could take 7 mini lots, which would be $70,000. You could take 3 standard lots, which would be $300,000. So we can take any position size we want as long as they are in increments of these values. So in the stock market, we're buying stocks. If you buy 100 shares of a company, you can buy 500 shares or 1,000 shares, but you're measuring it in shares in the stock market. In the Forex market, we're dealing in money. So how we buy money is simply in lots of money. So that is why we use these what we call lot sizes, and they're simply the volume of money. So if you buy 5 micro lots, that means you've bought $5,000 worth of a currency. Each pip movement is worth 10 cents for a micro lot, $1 for a mini lot, and $10 for a standard lot. So if this price goes from 102, or let's use the Euro USD, if this price goes from 13645 to 36461, that means it's moved up 1 pip. So depending on which side of the trade you're on, you're either going to make or lose 10 cents if you have a micro lot position. You're going to make or lose $1 if you have a mini lot position, or you're going to make or lose $10 if you have a standard lot position. So that goes for pairs where the USD is the second listed in the pair. If it's not the second listed, then you'll get slightly different pip values. So this is kind of standardized for when the US is the second pair listed, but we will have other pairs. As we get into trade examples, we'll look at that and ways to quickly determine what we call the pip value for currency pairs where the USD isn't listed second. So a little review, that's it for today. Currencies always trade in pairs. We can trade in mini lots, micro lots, standard lots. So a micro is $1,000, mini lots $10,000, standard lots $100,000. 1 pip movement for a micro lot is 10 cents, a mini lot is $1, and a standard lot is $10. Prices where the Euro USD isn't the second currency will have slightly different pip values, and again, when we look at some trade examples and stuff later on in the course, we'll go over exactly what those are. So in the next video, we'll highlight some spots where you can find free Forex charts and get yourself acquainted with the Forex market, and also show you how to read those Forex charts. Until next time, happy trading.